You've worked hard to build your real estate empire. You've poured your heart and soul into acquiring properties, managing tenants, and watching your investments grow. But have you considered what will happen to your hard-earned assets after you're gone? Estate planning is not just for the super rich. It is a crucial aspect of financial planning for everyone, especially real estate investors like you. A well-structured estate plan ensures that your assets are distributed according to your wishes, minimizes tax liabilities, and provides for your loved ones. Without a proper plan, your estate could be subject to hefty inheritance taxes, leaving your heirs with a smaller inheritance than you intended. Don't let the taxman take a big chunk of your legacy. This essay will guide you through the essential steps of estate planning, specifically tailored for real estate investors. We'll explore practical strategies to safeguard your assets and ensure a smooth transition of wealth to your beneficiaries. Let's get started. Imagine this. You've left behind a valuable real estate portfolio for your loved ones. But instead of inheriting your full legacy, they are slapped with a hefty tax bill. This is the harsh reality of inheritance tax, a tax imposed on the value of assets passed down upon death. The inheritance tax rate varies depending on the size of the estate and the state you live in. Some states have no inheritance tax, while others impose rates as high as 20% or more. For real estate investors, inheritance tax can be a significant concern. Why? Because real estate is often a substantial portion of an investor's wealth. When you factor in the potential for property value appreciation, the tax burden on your heirs can be substantial. But don't worry, there are ways to mitigate and even avoid inheritance tax altogether. By understanding the rules and implementing smart estate planning strategies, you can protect your assets and ensure that your loved ones receive what you intended. In the following sections, we'll delve into specific strategies to help you outsmart the tax monster and preserve your legacy. One effective way to reduce your taxable estate is by gifting property to your heirs during your lifetime. This strategy uses the annual gift tax exclusion. As of 2024, the exclusion is $18,000 per recipient. Married couples can double this amount. You can gift property at a discounted value. This reduces your taxable estate and minimizes inheritance taxes. Consult with a qualified appraiser and estate planning attorney to follow IRS guidelines. Trusts are powerful estate planning tools that allow you to control how your assets are managed and distributed, both during your lifetime and after your passing. For real estate investors, grantor trusts can be particularly advantageous. A grantor trust is a type of irrevocable trust where you, the grantor, retain certain powers over the trust assets. One of the key benefits of a grantor trust is that it allows you to shift future property appreciation out of your taxable estate. Here's how it works. You transfer ownership of your rental property into a grantor trust, with your beneficiaries, for example, your children, as the designated beneficiaries. You continue to manage the property and pay taxes on the rental income, but any future appreciation in the property's value occurs outside of your taxable estate. This means that when you pass away, the appreciated value of the property is not subject to estate taxes. Your beneficiaries receive the property with a stepped-up basis, meaning they inherit the property at its current market value, not the original purchase price. Grantor trusts can be complex, so it's essential to seek guidance from an experienced estate planning attorney to determine if this strategy aligns with your specific circumstances. Navigating probate like a pro. Todd deeds and revocable living trusts. Probate is the legal process of distributing assets after someone passes away. It can be time-consuming and expensive. For real estate investors, probate can tie up property sales. The good news is there are ways to avoid probate. Two common strategies are Todd deeds and revocable living trusts. A Todd deed transfers ownership directly to a beneficiary, bypassing probate. A revocable living trust allows control over assets and avoids probate. Streamline estate administration and ensure your assets are distributed according to your wishes. Section 6. Insurance, your secret weapon against estate tax surprises. Life insurance is often overlooked as an estate planning tool, but it can be a valuable asset, especially for real estate investors. Life insurance proceeds can be used to cover estate taxes, pay off debts, or provide liquidity to your heirs, ensuring a smooth transition of your assets. Here's how it works. You purchase a life insurance policy, naming your beneficiaries as the recipients of the death benefit. When you pass away, the insurance company pays out the death benefit to your beneficiaries, tax-free. This tax-free lump sum can be used to cover any estate tax liabilities, preventing your heirs from having to sell assets or dip into their inheritance to cover the tax bill. There are various types of life insurance policies available, each with its advantages and drawbacks. It's crucial to consult with a qualified financial advisor to determine the appropriate type and amount of coverage for your specific needs and financial situation. Section 7. The Family Meeting, Communicating Your Estate Plan with Grace. Estate planning is not just about documents and legal strategies. It's also about communication and transparency with your loved ones. Having open and honest conversations about your estate plan can prevent misunderstandings, reduce potential conflicts, and provide peace of mind for both you and your heirs. Schedule a family meeting to discuss your estate plan, explaining your decisions and the reasoning behind them. This is an opportunity to address any questions or concerns your family members may have, and to ensure that everyone understands their roles and responsibilities. During the meeting, provide your family with copies of important documents, such as your will, trust documents, and insurance policies. Let them know where you store these documents and how to access them if needed. By communicating your estate plan effectively, you foster a sense of trust and understanding within your family, making the transition of wealth smoother and less stressful for everyone involved. Time is money, and procrastination is the thief of time. When it comes to estate planning, delaying action could cost you and your loved ones dearly. Estate planning is not something to put off until you're older or facing health issues. The sooner you start, the better prepared you'll be. Life is unpredictable. Unexpected events can happen at any time, and without a proper estate plan in place, your loved ones could be left facing legal battles, financial burdens, and unnecessary stress. By taking action now, you gain peace of mind knowing that you have a plan in place to protect your assets, provide for your loved ones, and leave a lasting legacy. Don't wait for a crisis to force your hand. Start the estate planning process today. Choosing your estate planning dream team, attorneys, advisors, and more. Estate planning can be a complex process, involving legal documents, tax implications, and financial considerations. That's why it's crucial to assemble a team of qualified professionals to guide you through every step. Your estate planning dream team may include an estate planning attorney. An experienced attorney specializing in estate planning can help you create a comprehensive plan that meets your specific needs and complies with state and federal laws. A financial advisor. A financial advisor can assess your overall financial situation, provide guidance on investment strategies, and help you determine the appropriate insurance coverage. A tax professional. A tax professional, such as a CPA or enrolled agent, can help you minimize tax liabilities and ensure that your estate plan is tax efficient. A trust officer. If you choose to establish a trust officer can manage the trust assets according to your wishes and distribute funds to your beneficiaries as instructed. By working with a team of experts, you can feel confident that your estate plan is in good hands and that your legacy is protected. The ever-changing landscape keeping your estate plan up to date. Estate planning is not a one-time event. It's an ongoing process that requires regular review and updates. Laws change, your financial situation evolves, and family dynamics shift over time. It's essential to review your estate plan at least every 3 to 5 years or whenever there is a significant life event, such as marriage, divorce, the birth of a child or grandchild, or the death of a beneficiary. During the review process, assess whether your current plan still aligns with your goals and make adjustments as needed. Update beneficiary designations, review asset titling, and ensure that your legal documents reflect your current wishes. By keeping your estate plan up to date, you can adapt to life's changes and ensure that your assets are protected, your wishes are honored, and your legacy endures. Case study: how one investor saved millions with smart estate planning. John, a successful real estate investor, had amassed a portfolio of rental properties worth over $10 million. He was proud of his accomplishments, but concerned about the potential estate tax burden on his heirs. John consulted with an estate planning attorney who recommended a multifaceted approach: grantor trust. John transferred several of his rental properties into a grantor trust with his children as the beneficiaries. This allowed him to remove future appreciation from his taxable estate. Annual gifting. John utilized the annual gift tax exclusion to gift fractional interests in his properties to his children each year, gradually reducing the size of his taxable estate. Life insurance. John purchased a life insurance policy with a death benefit sufficient to cover potential estate taxes, ensuring that his heirs would not have to sell assets to pay the tax bill. By implementing these strategies, John significantly reduced his potential estate tax liability, potentially saving his heirs millions of dollars. This case study highlights the importance of proactive estate planning and the significant tax savings that can be achieved with the right strategies in place. Your legacy, your legacy. Take charge and secure your future. Your real estate investments represent years of hard work, dedication, and financial savvy. Don't let your legacy be eroded by avoidable taxes or legal complications. Take charge of your estate planning today. Consult with an experienced estate planning attorney, assemble your dream team of advisors, and implement the strategies outlined in this essay. By taking proactive steps to protect your assets and provide for your loved ones, you can ensure that your hard-earned wealth benefits the people you care about most for generations to come. Remember, estate planning is not just about protecting your assets, it's about preserving your legacy.